Hey everybody, David Skrika. So I'm gonna have a very interesting stock chart of the day / video, be a longer one on Monday. This one's gonna be very quick. I'm in Canada. I'm running around. I'm doing a few things today. I have to leave in about a half an hour, so I got to get this uploaded to YouTube and then posted to the site. So we're gonna make this very quick. So today we're just gonna look at today's stock chart of the day is small caps compared to large caps and just how cheap they are right now. So that doesn't mean small caps will go up, but it's just kind of interesting. It's a chart I saw on Twitter, and then I'm kind of doing my own thing here with it. So this is the Russell 2000, the small cap index. You can see that actually it only it yields 1.6%. It only trades at 11 times earnings. You can see over the last 5 years, it really has not done that much. In 2018, this ETF traded at 173. Now it trades at 182. So essentially in a 5-year period, it's only up about 5%. So that's annualized, like less than 1% a year. So then if we go look at the S&P, the S&P ETF is actually yielding less and trades at almost twice the valuation. So we can see, and then again, if we go look at the 5-year period, the spiders 5 years ago were trading at 290, now trade at 440. It's roughly, that's just 50% gains, or roughly 10% annualized a year. So like almost 10 times the return. And we go look at the S&P here, going back. This is again the Russell 2000 ETF divided by the S&P ETF. You can see we're back at the 2020 lows, which of course then the Russell had a huge gain. And then we're really the lowest level since about 2001. You can see it went a little lower in 2001, but when it went to that level, again, it's the same kind of thing that we're seeing now, that these massive big cap tech stocks, back then was Lucent, Oracle, Microsoft, etc., were driving the S&P up to new highs. And now it's Microsoft, Apple, NVIDIA, etc., are driving, Amazon are driving the S&P up to new highs. And of course, those stocks are not in the Russell. And I see it myself because I have a couple of small turnaround plays. And when the Russell underperforms like it does yesterday, I see these stocks sell off. So you can kind of see that. And of course, higher interest rates, because most of these Russell stocks tend to be graded below investment grade or junk, or etc. That's kind of affecting them in a negative light. So that can continue to affect them. And again, doesn't mean that the market has to go up. Like, for example, if we go back and look at this period, this is the Russell. You can see the Russell, even when it hit this all-time low ratio, still fell over 30%, into the 2002 bottom. So again, you can see, but the ratio kind of went higher, but it fell slower. That was the thing. Like, if we go look at, we'll put the S&P now here at the bottom. The S&P from 2000 to 2002, you can see fell 45%. So it probably means that from this level, the Russell has less downside. But if you're going to be in a bear market, it's still going to go lower. But on the other flip side, if you're someone who's not that bearish, to 2019, if you're somebody who's not that bearish, you can see that the S&P, went up here, since the beginning of 2020, roughly, and went up 43%. But if we go look at the small caps went up. You can see, actually, let's get it from, they only want 14%, but no, so let's get it from the bottom. Sorry. So 2020, sorry about that. The problems with let's go. We're going to get it from roughly the bottom in March, the end of March of that year. So you can see over the next year, the Russell went up 100% after it hit the super low ratio. Or if we go look at the S&P, went up about 40 to 50%. So like so it tells us that if we're in a bear market, there's probably less downside in the small caps. If we're in the bull market, probably in the short to intermediate term, there'd probably be more upside in the Russell at these levels. So anyway, I just wanted to point that out. And again, it's a similar scenario to 2000, more than 2020, when the Russell just kind of fell faster during the COVID collapse, where you've got these massive large cap tech stocks driving the S&P index higher and creating this dichotomy. So, and also too, like in 11 times earnings, we also know that earnings will decline in any potential recession. But again, that shows us there's much less downside in the Russell. Like even if earnings were to go down 20 or 30% and the stocks go down 20, 30%, you'll still be trading at 11 times earnings, where the S&P really needs to probably go to 14, 15 times earnings to represent fair value, at lower earnings levels, which is, probably a 40% decline from current levels if you were to see a recession. So anyway, I thought I'd leave it off on that, just showing you that small caps are a lot cheaper compared to large caps. Kind of backs up my view that the longs that I am doing are these beaten up kind of small cap companies. So thank you very much. I want to get this out quickly. So sorry for this not being longer, but I have a really interesting thing on corporate bonds for our stock chart of the day that will be out. I might even put it out over the weekend because I didn't do a chart of the day yesterday on Thursday. So everybody take care, and hope this was of interest.